Pratnesh Kumar, MD and CEO, BOB Capital Markets, now joining in on the show. Great to have you on board. Thanks so much for taking the time out. Let's talk about the overall scenario that's really playing havoc with the markets, and really that seems to be the unstable situation when it comes to the macros. Not to mention the global trade tensions aren't doing anything to assuage nerves. So how is it that you're advising one to approach the markets at this juncture, and what's your stance, Pratnesh?
So the advice right now would be to actually focus on fundamentals of the market, because some of the global factors that you mentioned, they are being driven by a whole lot of different forces, be it oil or trade tensions and other things. And in fact, the predictability of how, where, which way those things go is very, very hard for investors to figure out. What one can do during these kind of times is actually focus on the core fundamentals of the market. And to me, I think that is improving, because for the first time after many years, you are going to have earnings recovery. And naturally, be it the global volatility factors or even the domestic factors which will cause volatility in the market, be it on the political calendar side, etc., as well as the rupee, those things will present opportunities over the next 6 months for investors to invest.
Okay, you're saying that the overall fundamentals of the markets are looking good. So in that case, what is it that, an investor looking at the markets for a long-term standpoint should do? If they've got a significant exposure to the equity markets right now, do they just sit pretty, ride the wave of volatility, or do they look at nibbling in at the current levels, or is it time to book out? What's the advice?
So, if I look 12 months out, some of these factors causing volatility, be it the election outcome or dollar or INR, oil, trade tensions, chances are that some of these would have already played out, almost to entirety. So what the investors could look to do during this period is that over the next 6 to 8 months of volatility which is there, up and down, which will be seen in the market based on how these factors play out, is investors will constantly get opportunities. And so yes, one is sitting cautiously on the present portfolios, but as well being ready to invest when some of these things cause an excessive reaction in the market, which they tend to do, and that's the opportunity for investors. And naturally, from the whole periodic systematic investment plan also works, to capture good levels during a volatile period in the market.
Right. Pratnesh, in terms of individual sectors, what the large consensus seems to be that increase your overweight position when it comes to an IT and a pharma. But when it comes to financials, this is a little bit of a dodgy time, and especially NBFCs, which may have had a great run up until now, but considering it's a rising interest rate scenario, that whole hypothesis of NBFCs gets challenged. How are you positioned when it comes to NBFCs, small and large, across the segment?
So, naturally, NBFCs will have growth opportunities even going ahead. So that is not going to change. What will change is that naturally the money is getting tighter. Rates have gone up and are going up further. So I think what you saw in the market for NBFCs, there was a little bit of excess optimism that was built into the valuations, and I think that is where the challenge will be on the NBFC stocks. So I'm negative on NBFC segment as a whole, and so in addition to the valuation, I think a good number of NBFCs also haven't gone through a full credit cycle. So as they go through a full credit cycle, there will be learnings and there will be sorting out of in terms of the better and not so better. So I think at this point in time, I think the best run has been enjoyed already by NBFC, NBFCs, and I would be underweight there.
Where else do you think, Ratnesh, that it's time now to book profits at least, if not completely switch out of the sector?
So, what you've seen in the market in the last 6 to 8 months is that it has been held up by a select few stocks or sectors. So naturally, those companies are great companies, whether it is private banks or whether consumer non-durable companies. But in the process, what has happened is that the valuation gap or the valuation premium which has been enjoyed by those segment has gone very, very high. So at this point in time, I would, as great as those companies are, I would not sort of chase those valuations and rather look at areas in the market where which are part of the whole earnings recovery which is being seen, and as well as the valuation is not that much of a concern.
Okay, Ratnesh, what is it that you believe the overall the biggest risk for our markets is at this point? You've been talking about the overall macroeconomic backdrop. You've been talking about the fundamentals of the market currently. How important is the election going to be from a market standpoint? Should investors brace themselves for a lot of choppiness and volatility at that time? And how much importance should one lend to the election as an event purely from a market standpoint?
So it is an important event, no doubt about it. But there is one outcome which is going to happen at a particular point in time, after the next 8-9 months. So how should investors position for it is, in the run-up to the election, there will be all kinds of expectations, estimates, polls, and those kind of things will come, and that will cause volatility in the market in terms of which way those numbers come out. But ultimately, from the longer term perspective, what the market looks for from an election is a stable government, and till such time as the election results in a stable government, I think market will take the short term volatility in stride.
Okay. Yes, volatility is definitely going to be the big dominant factor, especially at a time of elections. What about sectors which you believe that one should avoid at a time like this? Those where you just believe that there's no valuation comfort, fundamentals look a bit tricky. Do you have any sort of view as to which sectors those would be?
Yeah, so I think to me, consumer non-durables valuations are very high. Sector may have defensive characteristics, but valuation, itself can be a risk beyond the business's characteristics. So I think that's one segment that I would avoid. I already mentioned NBFCs, and as well as I think in terms of the export-oriented sectors, to me, you've had some recovery in pharmaceuticals, but to me, I think that is a sector which is, from time to time, unexpected regulatory surprises come, and when the recovery is there, that's another segment where I would be underweight on. Rather, I would focus on sectors and areas which are part of the earnings growth recovery, and the valuation is less of a concern. So you could have corporate banks in that segment. You could have home building as a segment, because I think RERA is playing out extremely well in terms of consolidation there. So home building is another segment where I'm positive on, and in terms of overseas or globally linked sector, mid-cap IT is probably where I would have more of a preference, than pharmaceuticals.
Okay, Ratnesh, great having you on the show. Thanks so much for taking the time out and joining in.